Hey everyone, welcome to the June Redwood Money Client Update. I hope that your summer is off to a great start. We're going to jump right in and keep things really snappy with this month's update. So jumping right into it, just a few things that we're going to cover today. As always, you can access your financial plan or your investment login. It's at the bottom of all the emails. You can scan the QR code here to check in on any of your financial info as you'd like to. The few things we're going to cover today are it's time for summer meetings. So I sent out an email last week encouraging you to schedule a 45-minute meeting with me either in June or July. I'm going to recap my most recent newsletter on bear markets and recessions and how we should think about those. And then I'm going to tease a couple of upcoming videos. And instead of using these client updates to share, 25 minutes on financial planning topic, we'll keep these quick. And then I'll periodically post videos just on those financial planning topics going forward, just so that you can digest these things quickly and then watch those videos if you'd like to. So starting off with summer meetings, it's important to me that we meet on a consistent cadence. And as retainer financial planning clients, it's important for you to take a look at your plan. And I know that's something that you're counting on me to do, to reach out proactively, to talk about financial planning insights. And for many of you, we're still at the tail end of the implementation phase. So there's a lot of little things to take care of. So I want you to head over to redwoodmoney.com/meet. If you haven't yet scheduled a meeting with me as we head into summer, you can scan the QR code here on the screen to see my June availability or my July availability. I've opened up this meeting scheduler to have a lot of times so that we can all meet in the next 6 weeks or so. If you're planning with a partner, only one of you needs to schedule that meeting. Just go through the meeting scheduler, click on a date, and you can add additional emails. That could be your own work email and a personal email, or you can add other people like a spouse to that call. So please schedule those meetings so that we can connect on your plan. The second item we'll cover is this recap of the newsletter. And this was important to me, and that's why I wrote the letter in late May, was there's so many headlines recently about an upcoming recession, about the bear markets, about inflation, and I just wanted to provide reassurance and perspective that it's going to be okay. So I had 8 points in that letter, and I just want to recap them here. The first one is that continuing to buy and hold is still a sound strategy. And it's so funny, you read these articles on CNBC or other places about the bear market, and they'll have this sensationalist headline like 80% of economists think that there might be a recession in 2023. And then tucked at the bottom of the article is most financial advisors say there's nothing that you need to do with your long-term money. And I hate that because instead of helping people focus on what they should do and control, they focus on these items that are outside of our control. And we know this is a sound strategy to continue to buy and hold long-term investments because it's worked in the past, because recessions and bear markets tend to be short-lived and they're completely dwarfed by the times of economic expansion and bull markets. The second point I want to make is that a loss in your account is only realized if you sell those investments. So we're doing some tax loss harvesting right now for clients with Betterment accounts. If you've got an IRA that you might not tap into for many years, or you're only going to tap into a small proportion of it, I would just encourage you, just turn down the volume. Don't necessarily check on just those accounts. Look at your broader financial plan and write capital and recognize you get to decide when you sell those investments. And if we're selling investments, we're already talking about that. The third thing is we keep a cash reserve for times like these so that we have the option to not sell those investments. And I've been talking about with rising interest rates and opportunity in high yield savings accounts, and we're seeing that. Ally Bank, who's one of my favorites, they're kind of always going to be in that top 10% of high yield savings account yields. They've raised their yield from 0.5 up to 0.65 and out to 0.75%. I expect that by the end of summer, if there are 2 more rate hikes, that yield is going to be somewhere between 1.25% and 1.5%. So keep that cash reserve. We've set a liquidity target for you and make sure that it's in a place that's earning you yield. The fourth point is that this could be an opportunity. The stock market's the only store where when things go on sale, people run out. And what we tend to see in these times is people get scared when they see their account balances go down, but they neglect to recognize that if you're continuing to invest in a 401k, if you're putting money in the market, as we think about the long term of your investment time horizon, this could be an opportunity to buy stocks that are cheap. And while the broader market may be down 15%, 18%, there are technology stocks that are down 60%, 70%. And some of those are rightly so down. They were way overinflated. Other ones have just gotten beat up because of the broader macro environment. And I think these are great buying opportunities. And it's not just me. Point five is that smart people like Warren Buffett, who famously said, be greedy when others are fearful and fearful when others are greedy, he's been buying. He had over $100 billion of cash in Berkshire Hathaway, the parent company that he runs and controls. And over the first quarter of 2022, he deployed over $40 billion to buy stocks as they were declining. That's a smart investor. And that's the sort of person that I want to follow, not just a talking head on the news. The sixth point I want to make is that inflation is a more durable risk to your wealth than stock market losses. Inflation silently eats away, and sometimes loudly eats away. I mean, it feels that way in the last 6 months, but it eats away at your purchasing power. How we beat inflation so that your dollars can continue to purchase the same amount in the future, even if they're losing value, is we invest in things that are going to advance and keep pace with inflation. So the stocks are historically the best hedge against inflation. A very consistent way is to buy into businesses. And real estate's another good inflation hedge. Bonds aren't so good right now, but investing excess cash is really important right now. And so taking advantage of that opportunity to continue to average into the stock market is smart, because if you take money out of the market, we know that that money is losing value. And tomorrow we're going to have another inflation print. It's going to move the market. I would also remind you that even though right now we're seeing inflation at around 8%, if we look at the last 5 years, we're still averaging under 3% inflation, which is very much in line with norms. We're just in a weird season with the pandemic. As we come out of that, prices will normalize, and a lot of activity is being taken to try to reduce that inflation. So I just want to identify that as a risk, and the way we hedge that risk is by investing to beat inflation. Seventh point is, while I expect the stock market broadly to recover and to reach new highs, some individual companies will not. That's why diversification is so important, and we're going to build a diversified investment plan that includes U.S. stocks and international stocks and other asset classes like bonds and real estate. And finally, I'll just say this is why you hired a financial advisor, to be able to help you separate signal from noise, to hold your hand through these times of economic uncertainty, and to reassure you that if we have a solid plan in place, it's worth sticking to. And that's why we'll be meeting in the next couple of months to talk about any specific concerns you have and to help you to stay the course. Over here on the right-hand side, you can see something. As you think about recessions and bear markets, they're talked about as if they're the end of the world. But since World War II, in 1945, there have been 12 recessions in the U.S., one every 6.4 years, 14 bear markets, one every 5.5 years. And during that time, stocks, as measured by the S&P 500, are up 384,000%, averaging around 11.2% per year. So I wanted to provide that context for a couple of reasons. One is people who have just stayed invested during the long term, through bear markets, through recessions, they've done better than fine. They've done great. And the second thing is, it's important to reiterate these concepts, because if you're going to be investing, even if you're on the verge of retirement, we're probably investing for the next 20, 25 years. That means you've got probably 3 or 4 more bear markets and recessions ahead of you. If you're in your 30s, then you probably have 10 more bear markets and recessions if you're going to live into your 80s. So it's important to have a framework for thinking about these things and these good reminders, because we expect these things to happen. We plan around them, and then we can navigate them strategically by focusing on the areas of the financial plan that we can control. And that's what I'm going to be talking about in a couple of upcoming videos. A lot of you have been asking, where do I invest my next dollar? How can I be intentional with my financial plan right now? Maybe you're pulling back spending because you're seeing inflation, or you're concerned because you've got variable income. The two videos based on client feedback that I'm going to be shipping out between now and our next client update are this first one. You can see a graphic for it, which is this idea of a money tree, which is really prioritizing which accounts your money goes into. So I'm going to map out a money tree starting with your paycheck of where money goes to bank accounts, to employer sponsored plans, to tax advantage plans, taxable brokerage, and then everyday spending, and show you how this can help you to automate your finances and automatically build wealth. And then the second video that I'm going to share is all about budgeting and right capital. So some of you use that feature, others of you don't. If you want to use it, I'm going to share a video that walks through how to take full advantage of that feature, see your cash flow, see your expenses on an automated basis. This is really important to me because making smart decisions here related to how much you invest, whether you invest first or spend first, and whether you put money into tax advantaged accounts or not, those are things we can control. We can also control our budgeting systems. We can't control whether the economy goes into a recession or whether stocks enter their next bull market or they continue to hang out in a range right now. So I want to focus on the items we can control. That's what those videos will be about. And if you aren't yet subscribed to my YouTube channel, please go ahead and subscribe so that I can share these videos with you. Again, thank you for checking in. Don't forget to schedule those client meetings, and I look forward to connecting with you in the next few weeks.